good afternoon and welcome to today's Money Counts webinar. Today we are talking homebuyer education, which is a fun one, I think. My name is Allie Smith. I'm Assistant Director of Financial Counseling here at Penn State's Sokolov-Miller Family Financial and Life Skills Center. So I lead the one-on-one counseling or coaching program here at the center, and I also host this regular webinar series where we cover a new financial literacy topic every other week. And actually, as part of my intro, I'll share, before I started back here at Penn State about a year ago, I worked full-time as a realtor in residential real estate, helping people buy and sell their homes. So this topic is kind of near and dear to my heart. I'm really excited to share this one with you all today. Nick is also here. He is one of our wonderful financial literacy ambassadors. He'll be moderating the chat today and posting some helpful links and resources in there throughout today's webinar. So be on the lookout for those extra articles and tidbits of information that'll be coming through the chat. As you have questions, feel free to put them in the chat, or you can use the Q&A. Nick and I will both be looking at the chat, and we'll take a look at the Q&A at the end. The Q&A feature does allow you to ask questions anonymously if you'd like to take advantage of that. If you are here from Smeal's Ethical Leadership Challenge, we do have a QR code for you, and we'll post that at the end of the webinar today. Okay, so I think those are my housekeeping items. Before we dive in, as always, I'd love to take a quick minute to get to know who's in the room with us today. So I'm going to launch out a poll here. It's got two questions. The first is the standard, what is your affiliation with Penn State? And then the second question is, where are you on your own home buying journey? So hoping to get an idea of where you guys are at in the process of potentially purchasing a home here. We have a different mix of folks attending today's webinar, which I think makes sense with the topic in mind. A lot of staff. Welcome, welcome, welcome. And a solid mix of everyone at different places in their home buying journeys, it looks like. A lot of folks hoping to purchase their first home soon. Some people just are here to learn about the process, which is great. Some folks already own their homes and just want a refresher here, which is also great. And then we have some other people too. So feel free to let us know in the chat where you're at in your own home buying journey if you want to. If not, that's okay too. Okay, gonna close this poll out here. Thank you for sharing. I do appreciate having some context and where you're coming from. Welcome, everyone. I'll just start off by saying buying a home, of course, is super exciting and it's a really big step, but it can also feel a bit overwhelming and it can kind of be a stressful process. From my experience in working as a realtor and guiding people through this process, it seems like the more informed or willing people are to learn before diving in head first, the less stress they experience throughout the process, because generally they kind of know what's coming next. So I say this a lot in my webinars, I think, but knowledge really is power here and in a lot of other financial literacy topics too, right? Along with that, buying a home or a home might be one of the biggest purchases that you make in your lifetime. So it's really important to be informed before signing on the dotted line, right? So let's dive in here. Let's get informed. Today, we're going to be following our friend Ed through his own homebuyer journey. So homebuyer education. Get it, Ed? Okay, so these are the main steps Ed is going to kind of guide us through as he navigates his home buying journey. So how to determine your budget, how to research and remain organized as you navigate the search process, what's in a mortgage and what are the things that we should understand about our mortgage, how to actually make an offer, and then, of course, how to begin repaying your home loan. So when you're thinking about shopping for a house, the very first thing that you should consider is your budget. How much can you actually afford? If you're exploring Zillow and starting to dream about life in your new home, you want to make sure the homes you're looking at are realistic. So your budget is really a great place to start. Here on the screen, we have a healthy sample budget template, and this might look a little different for everyone. Not all of our budgets are going to be exactly the same, but I think this is a good starting place for any budget. Your budget should be based on your net income, right? Because that's the money that you actually have landing in your bank account on a monthly basis that you can spend. And as a general rule of thumb, since we're talking about housing here, you should aim to spend no more than 30% of your monthly net income on your housing costs. So this 30% would include all components of your mortgage, the loan itself, along with taxes, insurance, and private mortgage insurance or PMI if you have to pay that. We'll talk more in depth about these things later, but just for now, understand that your total housing cost should be no more than 30% of your monthly net income. So we really want to first estimate what is a comfortable payment, and then later we'll figure out how that translates into a purchase price for a home. As we start here, let's do a little math for Mr. Ed. Let's say Homebuyer Ed makes $58,000 a year. I did some searching on We Earn PSU, and I figured out that that is the average, or I think it's median actually. I might need to double check that. Average or median earnings of a Penn State grad after 5 years. So that's the number I used. So his gross income, $58,000 a year. His net income is about 30% less than that. So about $40,600 a year. So monthly, his net income is about $3,380. So this means to keep his housing cost under 30% and to stay within budget, he should aim to spend no more than $1,014, to be exact, on his monthly mortgage payment. Now, I think it's important to address, is this number always realistic for the area that you live in? Maybe not. So if you are approved to spend more by your mortgage lender and you decide to spend more than 30% of your monthly net income, understand that other areas of your financial life will probably feel a bit tight because, to put it bluntly, you only have 100% of your money to spend, right? And actually, I don't even want to say that. I want to say you really only have 90 or less, 90% of your income to spend, because we always want to be saving at least 10% of our monthly net incomes, right? That's not something that we want to let slide to get a more expensive place to live. And of course, we have to consider the fact that when we get a mortgage, this is a long-term financial commitment. So thinking about, is this going to be comfortable for me for somewhere between 50 to 30 years? So aiming to spend under 30% does give us a good starting place to consider our finances and our budget, but there really are some other questions you should consider before officially beginning your search. One of those being, what can you actually spend monthly on housing? What other financial obligations might you have, like student loan payments, childcare, car payments, that kind of thing? You'll really have to take a holistic look at your budget here. And if your budget doesn't allow you to spend up to 30% of your monthly net income on housing, you'll need to be aware of that. This could be a good time to figure out what percentage of your monthly net income you currently spend on housing. If you currently pay for your own housing, and since we had some undergraduate students here, so maybe you don't currently pay for housing, but I would assume most of us staff members do. So this could be a good exercise. What percentage of your monthly net income currently is going to your housing payment? How does that percentage feel to you now in your budget and your overall financial life? Next, do you have an emergency fund? Things in homes can break, and unlike with renting, it'll be on you, the homeowner, to fix the things that need fixing. So as a reminder, your emergency fund should contain at least 3 months of your expenses. And as a homeowner, you might even want to bump that up a bit. Maybe you're more comfortable with 4 months or 5 months. How much do you have saved for a down payment? 20% of the home's purchase price is a great goal, but you don't need to have that amount saved. There are loan programs that will allow as little as 0% for first-time home buyers to 3% down. So the more down payment you have, the lower your monthly payment will be, and the less you'll spend on interest over the entire life of the loan. And it is really crucial that you don't spend your entire savings on your closing costs and your down payment. Your down payment savings should be really separate from your emergency fund savings. And do you have any big life changes coming? Maybe you're thinking about starting a family or getting a new job or starting a business. These things most likely will change your financial situation, so they're things you want to consider. If you're a dual income household, will it stay that way? Or might one partner take some time off work to care for children? Purchasing a home is a really huge long-term financial commitment, and you want to make sure you'll be comfortable making the payment that you agree to for the next 15 to 30 years, right? One more question I would add to this list of questions here is, how long would you plan to stay in the home that you buy? Ideally, it's at least 5 years because the housing market can fluctuate just like the stock market fluctuates. And you want to be sure you can sell your home for more than or at least what you paid for it. Buying a home is an investment, and we don't want to be losing money on our investment. So the longer you keep your home, the more likely you are to have more equity in that home, which means that you'll be able to sell it for not a loss, right? So planning to stay in the home for at least 5 years is a good goal. Before going in and talking with a lender to get a pre-approval, you really want to have a solid understanding of your own budget and your own personal financial situation. And asking yourself some of these questions is a great way to begin. And of course, you want to remember to include other decision makers in the household in these conversations. It's important that everyone's on board here. So once you've thought about your finances and you've talked about your finances with those that you need to talk with them about in your household, and you've kind of figured out your budget and how much you can afford, and you've asked yourself some of those critical questions, it's time to start researching and getting organized. So Ed is here. He is browsing Zillow and taking notes. He's getting excited. To start to research and kind of like window shop properties, you can use real estate sites like Zillow or Realtor.com. These are good real estate resources that connect directly with the platforms that realtors themselves use. So when properties are listed, they automatically display on these real estate sites. So by using these, you're able to kind of see the market basically in real time, which is nice. Here on the screen are some examples of things that might help guide your search. So take a minute to read over this list, and if you want, let me know in the chat which of these factors would be most important to you in a home. It can be these things we have, or if there's something else that's really important to you that you don't see on the screen here, it can be that too. I think as you're kind of thinking about this, in my time in working as a realtor, I saw a lot of people be really focused on location. I mean, location is huge, right? How far you are from work, how far you are from grocery stores, daycare, that kind of thing. And school district also seem to be very important to people. Okay, I'll say this. I'll let you think about it a little more. Share if you want. If not, that's okay. Um, from my experience in working with first-time home buyers specifically, because it does look like we have quite a few potential first-time home buyers in our audience today. So my experience in working with first-time home buyers and in like buying my own first home, typically we as first-time home buyers can't get too picky with starter homes. So oftentimes first-time home buyers will need to choose one or two priorities along with affordability and kind of start there. So maybe it's location and at least 3 bedrooms and price, for example, and those are the grounds in which you start your home search. So this is also probably when Ed or you as a home buyer wants to start playing around with a mortgage calculator to get an idea of how much house that he can afford within his, what was it, $1,014 monthly budget. So Nick threw a mortgage calculator in the chat. Feel free to play around with that. You will need to enter a few things and you'll kind of need to do it backwards in a way. So it won't allow you, this one specifically, there might be other ones out there that do, but this one specifically won't allow you to put in a price that you want to spend and let it shoot out a purchase price, but you'll kind of need to do it backwards. So you can play around with purchase prices in that mortgage calculator. You'll also need to enter your down payment and the interest rate. It does look like rates are currently around 7.5%, so you could enter that. Depending on your credit score, of course, your rate could be slightly lower or higher than that. That's just maybe a good starting place. In a calculator like the one that we shared, you'll also need to enter things like property taxes and insurance costs because those are part of your total housing cost. We'll talk more about the components of a mortgage and the taxes and insurance and PMI later on. So feel free to kind of keep this calculator up and fill in some things as you go. But as you browse online real estate sites, you can also look at price per square foot to get an idea of where a listing sits relative to other listings on the market. So this can also be a helpful comparison tool. Some additional things you should think about here are your must-haves in a home, how long you're willing to search, and when you want to move in. Something I do want to share regarding timing that I think is really interesting is after you close on a home, you don't make your first mortgage payment until 1 full month has passed. So, for example, if you close on your home, let's say June 15th, you won't actually make your first mortgage payment until August 1st. So you'll finish out the month of June, and then another additional full month will pass before you make your first mortgage payment. So this is really helpful to know, I think, for potentially coordinating like lease end dates and potentially preventing you from making a double housing payment, which could be very expensive. As you are starting to think about looking at homes and you're getting organized, it's a good idea to set up some sort of organization system for yourself. How will you remember each property that you see? You, throughout this process, might end up seeing a lot of different homes, so you should really come up with some sort of method to stay organized so you can remember what you liked and didn't like about the homes that you've seen already. Searching for a home really is a learning process. You'll learn a lot about what you like and what you don't like. And you may actually end up feeling differently about certain things than you did when you initially started your search. I saw that a lot in my time in working directly with folks as they bought houses. And then, of course, we can't forget, what are taxes and insurance? This is specifically property taxes and home insurance. And it's important to be aware of those things because they'll be included in your monthly housing payment. So it's a good idea to check a tool like Zillow for the area you'll be searching in and look at the property tax amounts that you see. You'll probably see them in annual amounts, but divide that by 12 and you can easily come up with a monthly amount that will be included in your mortgage payment. As for home insurance payments or premiums, these can vary, but the average annual cost of homeowners insurance in Pennsylvania is about $1,400 a year, which comes out to about $116 a month. Generally, the bigger the house, the more you're going to pay for taxes and home insurance. As part of the preparation process, you'll choose your realtor and your lender. This will be your team who will get you through this process to the finish line. So these people should really be honest and trustworthy. Your realtor will assist you through the home buying process from start to finish, explaining the process, educating you on the market conditions, helping you do paperwork, negotiating on your behalf, and really representing you through closing. Realtors are paid from commissions. Realtors don't make hourly wages or salary or anything like that. And there are actually some big changes going on right now with buyer agent commissions specifically. You might have heard some of the drama, I'll call it. So in times past, it used to be free to work with a buyer's agent because the seller of the home paid both the buyer and the seller agent commissions. But the National Association of Realtors, or NAR, was recently involved in a lawsuit, and this old compensation model is sort of collapsing. So as far as we know, sellers will no longer be forced to pay buyer agent commissions, it seems like, starting in July of this year. So what does this mean? Really, it means buyers will likely need to find a way to compensate their buyer agents directly if they choose to work with one. I've also read some articles and listened to some podcasts on this that suggested the scope might become more of like a choose your own adventure type thing where, where buyers agents might have different levels of service that they provide, and you choose which one that you want, and that's what you pay for as a buyer. So maybe you want full representation, top-notch service, and you'll pay for that. But maybe you also decide you can do a little bit more of your own legwork, and maybe because of that, you can negotiate a lower fee with your agent. It's really hard to say how this is going to shake out, but I do think in the next few months, things are going to change. So it's important that you communicate with your agent upfront about these changes, of course, with the understanding that they aren't going to get paid automatically from the seller anymore. And of course, they do expect to be paid for the work that they do. I think a good realtor will have this conversation with you during, the first time that you talk with them. You should be expecting that, I would say. And if not, you can always bring up that conversation because it is important. As for the lender, you can choose any bank that you like for your mortgage. Most times your realtor will be able to connect you with a good lender, or, vice versa. If you have a lender that you'd really like to work with, they might also be able to connect you with a good realtor. Realtors and lenders work very closely together very frequently. And so if you have a good one or the other, they'll likely be able to connect you with someone that they've worked with that gives them and their clients a really good experience. So don't be afraid to ask for recommendations from either your realtor or your lender. The lender will pre-approve you and talk about the costs associated with your home purchase. So things like your down payment and your closing costs. They'll also be able to tell you what loan programs or grants that you might qualify for to help you save money on your home purchase. There are some first-time home buyer programs that help people in different ways, help first-time home buyers specifically in different ways to, actually be able to purchase a home. Some examples of that are, we'll talk about private mortgage insurance later on, but sometimes first-time home buyer loan programs will waive private mortgage insurance, which can be really helpful. And sometimes first-time home buyer programs will allow you to purchase a home with as little as 0% down, which of course, these things are helpful for first-time home buyers who tend to be younger and less established in their financial life, right? When you're ready to start shopping for a realtor and a lender, I suggest asking homeowners that that maybe live locally to where you want to live, who they used and how their experience was. Ask them to be really honest and if they would suggest using the same folks. Also, be sure to check out reviews before you choose. Zillow, Realtor.com, and even Google business pages are all great sources for realtor reviews specifically. And in searching for a realtor, you want to make sure it's a good fit because the home buying journey can be lengthy sometimes. And so you might be working with this person for quite some time, maybe a few months. Different people have different working styles, so you just want to make sure you jive with this person. So again, this is your home buying team. These are going to be the people who get you through this process to the finish line. You really want to make sure that they are honest and trustworthy because they will be representing you in one of the biggest, potentially the biggest purchases of your life. You will work with your lender to get pre-approved, and you'll need a pre-approval document to submit an offer on a home. So you want to be sure you've got this in hand before you start going out and actually touring homes with your realtor. There is a difference between pre-qualification and pre-approval. A pre-qualification is based on information that you give the lender. And a pre-qualification is really a good tool to use to comparison shop because a pre-qual is not going to give you a hard inquiry on your credit report. It's just based on the info that you provide to the lender. And then a pre-approval is based on facts. So to give you a pre-approval, the lender will pull your credit score. They'll also want you to provide some documentation for things like your income and your assets. Once you've decided on a lender, it's a good idea to get the official pre-approval for your estimated loan amount so that when you're ready, so that you are ready to make the offer once you find the perfect house for you. Note that a pre-approval will result in a hard inquiry on your credit report because the lender will actually run your credit score. So this is a good time then to get your documents in order as your lender will want some of these things to give you a pre-approval. And there are some other items that you'll need as you go under contract on your home purchase. You might hear me say under contract a few times today, and really under contract just means that you've submitted an offer to purchase a house that is for sale, right? The seller has agreed to that offer, you've come to an agreement, and you are now under contract to purchase that home. So the seller, when you're under contract, is really expecting that you purchase the home, right? You've signed a contract and you're moving forward through the transaction process. So these are some of the things that you'll want to gather as you are thinking about getting pre-approved, as you're thinking about starting your home search and going on tours, that kind of thing. Some of these items can be found on your credit report as well if you're not sure. Maybe you've moved a lot and your life's been a little crazy in the last 2 years. You should be able to find some of these things on your credit report. As for your application fee, This is the cost of the appraisal and your credit check. This is one of the upfront costs of purchasing a home. So you'll pay for these things shortly after going under contract, and the total for these items is usually about $600. So as you're starting to shop for a home, you really want to make sure that you have about $600 in a bank account ready to go to give to the lender once you're under contract. And then also you'll need to have the sales contract signed by everyone, the buyer and the seller. Of course, you won't have that in hand until you are actually under contract, right? Okay, so now that Ed has figured out what he can afford, he's done his own research, he's collected his documents, he's really ready to move forward here with learning about his mortgage. Put simply, a mortgage is a loan for a property. It can be a home, land, or other real estate. When a bank gives you a mortgage, they'll place what's called a lien on your property until the mortgage is paid. So the property itself serves as collateral, and if you don't make all the payments on the property, the bank can swoop in and take that property back. A mortgage does have predetermined payments, and I think this is one of the positive things about a mortgage. As long as you have a fixed interest rate, your payments will be the same for the duration of that loan. So a mortgage is kind of inflation proof in that way, right? Rent can go up over time, and your property taxes and insurance will probably go up some, but the mortgage payment itself will remain the same for the duration of your loan. Okay, so let's look more closely at the components of a mortgage. Your loan will be made up of principal and interest payments, but there's also property taxes and insurance, as we've discussed. All of these things will be combined and they'll make up your mortgage payment. Taxes and insurance will usually be paid via your escrow account. An escrow account is just a holding account. You can pay all of these things to your lender on a monthly basis, and your lender will take care of paying your taxes and your insurance on your behalf. Some lenders will allow you to pay your own property taxes and your own home insurance premiums, but they might raise your interest rate to do that. And letting them do it for you just kind of takes that responsibility off of your plate. So why not let them, just do it for you? It'll just go into that escrow account, and then your lender will take care of paying those bills once they are posted. And just to reiterate, so we talked about our budgets at the beginning of this webinar, right? We talked about the fact that ideally, we want our net monthly housing payment to be no more than 30% of our monthly net income. Sorry, I said net monthly housing payment. Our housing payment, we want to be under 30% of our net monthly income. So that includes all of these things. And it also includes potentially private mortgage insurance. So this can be an additional element of your mortgage. You might hear it stated as PMI, private mortgage insurance. It's an additional monthly cost along with all of these other items. Typically, if you have to pay PMI, it's because your down payment is less than 20% of your home's purchase price. I will say most of the first-time home buyers that I worked with during my time as a realtor did end up paying PMI. 20% down can be a huge chunk of change, and it's not something that typically first-time home buyers have access to unless they've saved diligently for a really long time. So if buying a home is a goal of yours and you don't have 20% down, you shouldn't necessarily let that stop you. But it is important to know that private mortgage insurance is going to be a part of your payment for a while. How much the private mortgage insurance portion of your payment actually ends up being depends on a few things. Your loan amount, or how much you're borrowing versus how much you put down, and also your credit score. So the idea here behind this private mortgage insurance is that the more risky you look to the bank, the higher the private mortgage insurance payment will be. Once you hit 22% in equity, that private mortgage insurance is required to go away automatically. But if you pay close attention, you can reach out to your bank and have it removed once you hit 20% in equity. So I would recommend kind of calculating what date you're going to hit that 20% equity and just putting it on your calendar to call up your bank and get your private mortgage insurance removed at that time. Otherwise, you'll pay it for slightly longer before they remove it automatically. And then just to note, PMI does differ slightly when you change up loan types. So for example, with a FHA loan, which is a government-backed loan, it's not called PMI, but it's called MIP, which stands for Mortgage Insurance Premium. So you'll really need to, in the process of working with your lender, just see which type of loan, whether that is a first-time home buyer loan or a government-backed loan, or maybe just a conventional mortgage, which type of loan is really going to be best for you and your situation. Again, I have seen some first-time home buyer programs that will allow folks to put less than 20% down and not have to pay PMI. So be sure to ask your lender if that's an option, or you could even seek out a lender at the beginning of your search that offers those types of programs if you feel like that'll be helpful for you. So when you're shopping for a loan, you should be cognizant of your credit score. The better your score, the better your interest rate will be. Having a good credit score can save you money on your home, especially over time when you zoom out and look at the long term. Oh, we have a good comment in the chat here. You can also remove it if your home goes up in value, which would increase equity as well. I got PMI removed after 2 years. That's fantastic. Yeah, so it's a good idea to have some idea of what your home value is, especially as it changes over time. And I believe if that's the case, you would still have to call up your lender and have them remove it. I highly doubt that they would just remove it themselves. So you got to stay on top of those things if you want to save some money. Another way that you can save some money potentially is by having a good credit score, right? Which might help you get a better interest rate. If you're planning to buy a home in the next year or so, you should really take the time to pull a free credit report from one of the 3 credit reporting bureaus and kind of comb through that credit report. Make sure all of the information on there is accurate, and if not, you can dispute the incorrect information and have it removed. You can pull a credit report for free at annualcreditreport.com. Having an idea of the current interest rate environment is important also. Your realtor and your lender should have this conversation with you and explain the rate environment as they're talking about the market conditions and kind of where things are at the moment. Right now, it does look like rates are around 7.5%. And of course, your rate specifically could be higher or lower based on your situation and your credit score. One tip I'll share before we move on is if you are planning to buy a home in the next year or so, it's a good idea to avoid taking out any new loans or credit cards if possible. Okay, so there are some options when it comes to how long you want to be paying this mortgage. Options range from 15 to 30 years. Typically, the 15, 20, and 30-year options are the most popular options. So with a 15-year mortgage, typically they'll offer you a lower interest rate than you would get with a 30-year mortgage. So you'll pay less interest because of that. And also because the loan has been kind of condensed in a shorter period of time, you'll also pay less interest because of that. That will give you opportunity to build equity in your home faster. But of course, your monthly mortgage payments themselves will be larger when you go with the 15-year mortgage. On the other hand, there's also 30-year mortgages these tend to be more popular because, of course, they do have smaller monthly payments, and they can be more manageable, especially for first-time home buyers. Something you can do here with a 30-year mortgage is to try and pay it off a little early by making extra payments where you can. If this is your plan, you do want to be sure that there isn't any sort of prepayment penalty in your loan documents, and that's something that would be a good idea to verify with your lender. But in a way, this has some flexibility, right? Just as if you think of a student loan or a credit card, there are required minimum monthly payments, but you can pay extra and you can save yourself some money on interest over time by paying extra. So that's absolutely an option with something like a 30-year mortgage as well. Another mortgage option to consider is whether you'll be taking a variable rate or a fixed rate. With a variable rate mortgage, the rate will vary at some point, hence the name, right? Most variable rate mortgages will be fixed for a set period of years, like for the first 7 years or for the first 10 years. Then it will vary from there. So if you've got a 7-year variable rate mortgage, for example, that means on year 8, the rate will change. And what it changes to will be tied with the interest rate environment at that time. So if rates are generally higher, it'll be higher. If rates are generally lower, it will drop. And this will affect your payment as well. So it's important to be aware of that. A fixed rate mortgage is just that. It's fixed. The payment will remain the same for however long that loan term is. So if it's a 15-year fixed rate, you're going to have that rate for 15 years until your loan is paid off. If it's a 30-year, same thing, it's going to remain the same for that entire 30 years. So when people think about mortgages, I think typically they have this fixed rate mortgage in mind. And again, these are kind of inflation proof, right? Because your payment is going to stay the same. Taxes and insurance might go up a bit, but otherwise it'll be the same. And think about a span of 30 years. That's quite a long time. And your income might go up significantly in that time. Like if you buy a house when you make $40,000 a year, or Ed, we said he made $58,000 a year, and it's a comfortable payment for you at that time, and you keep that house for 15 years, 15 years down the road, you're hopefully going to be making much more, right? So in that way, maybe your mortgage payment will become a smaller piece of your budget pie as your income grows. And if we think about rent versus a mortgage, a rent payment certainly would go up in 15 years or 30 years, right? Okay, so once you've got all of your documents together, you've got your pre-approval in hand, you've been communicating with your lender and you're working with your realtor to tour some homes, and finally, you found the home that you think is the one for you. That means it's time to submit the offer. So your offer will include not only the purchase price that you are offering the seller for the home, but it will also include what inspections you're getting. I would always encourage home buyers to get a home inspection. You really want to know what you're getting into when you're making a big investment like this. So you want to know if this home has issues, what are those issues? When you elect to get an inspection in your offer to purchase, you also get what's called an inspection contingency. And that means if you go through with your home inspection and the inspector discovers something terrible that makes you no longer want to purchase the home, you are allowed to leave the contract. When you put in an offer on a home and you come to an agreement with the seller, you're under contract to purchase that home, right? And you can't easily break a contract. Contracts are legally binding. But an inspection contingency does give you the ability to do that in the event that something bad is discovered during those inspections. Another part of your offer will be the down payment that you have. You'll also have to disclose who your lender is. And you'll need to include an earnest money deposit with your offer. An earnest money deposit basically just acts as security for the seller, keeping you on the hook in this legally binding contract. Typically, earnest money deposits are between 1 to 2% of the home's purchase price. If you're competing for the house, you might include a little extra earnest money just to show you're really serious about purchasing this home. But what will happen with the earnest money is it will just sit in an escrow account, which, if you remember, an escrow account is just a holding account, and then it will be credited back to you at closing. This earnest money acts kind of like a security deposit for the seller, that you're not just going to break this contract and go off and buy a different house. So we did touch on the inspection contingency, and if you leave the contract via the inspection contingency, you will get your earnest money back, because that is a legal reason to leave the contract, because you have that contingency. So in that case, you're allowed to legally break the contract. If you illegally leave the contract, however, the seller does have the option to keep your earnest money. So it's really important that you're not making an offer unless you are really sure about the house. And then last but not least, you'll also need to include an estimated closing date in your offer. And of course, your closing date is the day that the keys are transferred. That home is yours on closing day. Okay, so then on closing day, you'll need to bring a cashier's check for your down payment and your closing costs. Aside from the application fee that I mentioned earlier, which is about $600, most of your costs will actually be paid at the closing table. So this is when you're sitting down to sign all of your paperwork and get the keys. You'll have to bring this check to closing with all of these costs included. So this could be a big check, a big chunk of change, right? Your down payment could be 20% of the purchase price. That would be fabulous. If not, remember that you'll have to pay that private mortgage insurance on a monthly basis. And then it will also need to include your closing costs. I think people tend to forget about closing costs. These are completely separate from your down payment, and they typically amount to about 3 to 6% of the home's purchase price. If you are short on funds and you really only have the funds for your down payment, but not for your closing costs, you can ask the seller to pay a portion of your closing costs. And of course, that would need to be part of your offer when you submit an offer to purchase. So that would be part of this, right? Of course, the seller does not have to agree to pay any of your closing costs, but if you're short on funds, you can make that ask. And then, of course, you can't forget about any moving expenses as well. You want to be able to budget and plan for those, especially if you're making a big move cross country or across the state. You might want to try and negotiate with your employer some sort of relocation bonus or relocation, what's the word? When they give you money back. I'm having a brain fart, but you guys know what I mean. Refund works. I wasn't actually thinking of refund, but all good. Reimbursement, there it is. Yeah. Some sort of relocation reimbursement would be fabulous if you can negotiate that with your employer. I appreciate you all. Thank you. So then after closing date, repayment begins. It takes a while for repayment to kick in, but let's just say Ed is here. He has closed on his home, and now he is in the place where repayment begins. So this is what Ed ended up settling on. This is his loan amortization schedule. We can see that his first payment started in July. So we can kind of assume, because his first payment is starting in July, that he closed on his home sometime in May, right? So maybe he closed May 15th. He finishes the month of May, and then he has a whole month of not having to make a mortgage payment. And then his first payment would start the following month in July. So Ed got his house for $165,000. Go Ed, that is a steal, and that is also within budget. So that's great. He has a fixed interest rate of 4.25%. He elected the 30-year mortgage term, and his monthly payment is $811.70. And the total interest that he's going to pay over the life of the loan, if he doesn't make any extra payments, is going to be about $127,000. That is in addition to the loan itself of $165,000. So, I mean, just with that in mind, can show why it might be advantageous to make a few extra mortgage payments when you can, right? This is also a low interest rate, so maybe he doesn't want to make any extra mortgage payments, and maybe he would be happier with investing some of his extra money, and that's okay too. So notice here, just looking at this amortization schedule, that with each payment, principal increases slightly and interest decreases slightly. So his payment holds steady. It's going to be $811.70 throughout the life of the loan. But as he's progressing throughout the life of the loan, he's going to be paying more towards principal and less towards interest. So he is very slowly chipping away at his balance here. He's gaining more equity in his home as he pays down that principal balance. And hopefully also his value of his home increases as well. Okay, so Ed is happy because he has a house, but you might be feeling overwhelmed. The home buying process can be stressful, and there's a lot of details and things to think about, a lot of moving parts as well. So there are resources that can help, including the Pennsylvania Housing Finance Agency. We'll post a link in the chat here, but the website's really simple, phfa.org. They've got online home buyer courses, and you might also be able to find some local home buyer counseling as well, which could be really helpful. We are also here to help, of course. We really are here to support and guide you in your journey to financial wellness. Any current students can schedule a one-on-one appointment through Starfish to talk through their financial questions, get personalized education and guidance from either me or one of our other one-on-one appointment providers. And we do partner with PNC to offer financial coaching to staff and faculty. It is also for free through PNC. If you're interested in being connected to someone at PNC, you can email us at finlit@psu.edu. or it's finlit@psu.edu, and we'll get you connected with folks over at PNC. We did also post our Homebuyer Education self-study module in the chat. Our self-study modules are free to the public. Anyone can go in there and learn via those, which is really great. And we also will have this recording posted on our YouTube as well in the next few days. You can find all of our services on our website, which you can find by scanning the QR code on the screen or going to financialliteracy.psu.edu. Okay, thanks for tuning in today. I hope you learned something that will help you on your home buying journey.